Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just our usual disclaimer: the types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today is kicking off as usual with the major equity indices. We have seen a lot of movement in the last minute or so as CPI data has just come out, a little bit less than forecast. So that is going to act as a strong tailwind for equities. So we'll discuss that further and we'll discuss where price could potentially head towards. From there, we'll be taking a look at fixed income and commodities. We'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at a couple of subsectors of interest that I have for you today. And as usual, ending the webinar with some bullish and bearish market observations. So the S&P 500, pre-market, when I took the screenshot, was still at 440, so pretty flat. However, that has jumped to 445. A big jump due to the CPI data coming out better than expected. So what does this mean? Well, it means that inflation is on track to getting to the longer-term target of 2%, which is great. And it also means that the Fed does not have to be aggressive with regards to its interest rate hiking policy, because inflation is coming out a little bit better than expected. Now, with lower interest rates or more dovish outlook for the Fed, we know that that could very well lead to equities moving higher, hence the big jump in the pre-market price. So right now, price set to open at around 445, 446 now I'm looking at, and that could very well continue higher. But when it comes to the trading outlook, you can see just how much price has rallied in a few short weeks. 410 all the way to now 445 this morning. That's a pretty significant, rally in a very short space of time. And because of that, I do think price is a little bit overextended. So therefore, the risk reward does favor the downside in the short term. So short term, I am still looking at potentially fading this rally. Especially when we take a look at the market observations, you'll see there's some opportunities to fade. But again, very much dependent on how price reacts to the CPI data. And once we get that fade, once we get a bit of a pullback or some consolidation, we could very well see a continuation higher. So price breaking above this key level here, was it just below 440. We saw price break above it on Friday. Not a lot of price action yesterday. I think investors are waiting on CPI data to come out, and a big jump higher this morning. So it does look like it can continue higher, but the risk reward does favor the downside. So what we could see is actually a retest towards this previous area of resistance turning support, and from there be looking at a continuation higher here for the S&P. There definitely does seem to be a lot of momentum in the markets. We're definitely in more of a risk-on environment. So we are seeing that rotation of the safe havens away from the defensive sectors and towards equities and especially growth stocks, which is driving the major indices higher. So short-term bearish for the S&P, longer-term definitely bullish. Oh, the other thing was positive divergence. I know I mentioned this last week, but we saw price making a lower low in terms of the momentum, the 50-period CCI, which is a blue histogram, making a higher low. And that is a very positive indicator, but usually by the time you see it, it's a little bit too late. So you always wait for a bit of a pullback to confirm a higher low, whether it be at 420 or in this case, just below 440. And then from there, you can look for bullish positions. So quite a few bullish confluences here for the S&P. The other thing I wanted to discuss was the fact that this week, after the CPI data, we still have some high volatility events, especially on Thursday with a lot of the big name retail names announcing earnings. We have Target, Walmart, Macy's as well, and a few of them. So that could very much cause some volatility. And I think, when it comes to looking at retail numbers, I mean, we also have retail sales coming out. But when it comes to looking at retail numbers, what we learned from this earnings season so far is even though we were getting beats on revenue and beats on EPS across the board, the forward guidance on these companies has been somewhat negative, which is why even though you see, an upside surprise for the EPS and revenue numbers, we tend to see a gap down lower for a lot of the stocks after the earnings announcement. And that forward guidance usually has to do with they're expecting lower consumer spending towards the end of the year. So this retail sales number that's coming out later this week will be closely watched. That's definitely going to have a bit of an impact on where equities head to next. But the Fed will have the biggest impact, that's for sure. Right, the Qs, looking at the NASDAQ 100, breaking above 370 on its way towards that 380, 385 area here with plenty of momentum. We are in a risk-on rally, and therefore we're seeing a lot of rotation back into technology, back into growth, and that's what the NASDAQ 100 is primarily made up of, companies that are in the technology and growth spaces. So we're seeing price approaching 380. I'm not sure what the pre-market is now after CPI, but it will be higher given the fact that the S&P 500 had a big jump. And again, like the S&P, waiting for a bit of a pullback before committing to a long opportunity. But I do expect outperformance for the NASDAQ relative to the S&P 500. IWM, the Russell 2000 ETF, after that bounce at around 163, we saw some very bullish price action to see price breaking back above that 170 level, which was a 50% fib level, and coming back down to essentially retest it, slightly break below it, and we're seeing clear underperformance. Now, price is set to open at around 173 this morning, so just below that 55-day exponential moving average, and that does bode well for the Russell 2000, but like I said earlier, or like I said in the last few months, we are still seeing that continuous underperformance for the Russell 2000 relative to the S&P 500. And you can see that by the fact that price was unable to break above its 55-day exponential moving average, whereas the Qs, the S&P, both above that 55-day exponential moving average. So bullish exposure when it comes to the major indices. I think it makes more sense to look at large caps as opposed to small caps for now. So TLT, the Treasury Bond ETF. Now, TLT pre-market, let me take a quick look, is at 89. So pretty much at this 55-day exponential moving average. We could see a breakout from this level today. Let's see. We know that yields have found some support, especially the 10-year yields at around 450 basis points. But if we do get a breakout here for TLT, meaning that yields move lower, the next key level would be at 92.50. That's the previous swing level. I think overall price structure still remains quite bearish, but definitely not as bearish as it was a few weeks ago. We are seeing signs of a dovish pivot from the Fed. The data that's coming out in the last few weeks is supports a more dovish Fed. Jobs numbers coming out less than expected, and of course inflation data coming out less than expected. So this could very well see the Fed become dovish quicker, but that will see a reduction in yields, and we could see TLT actually move higher and recover from this level. So even though price is at this somewhat of a bearish structure, keep a lookout for potential breakout opportunity at around 90. Under normal conditions, I would always say short TLT into these rallies, but it seems to be holding up above that 87, 86 level quite well. All right, the US dollar index, DXY. Price breaking back above 105.50. This was an important level that we've spoken about for quite some time because it's a major level of resistance now turning support. In the last 3 days of price action, we've seen a bit of a pullback towards 105.50. Definitely a slowdown in momentum compared to early July all the way through to around early October, where we saw a very strong rally, taking price from the $100 level to around 107. But with the US dollar index losing out on momentum, it is vulnerable to a breakdown. I also think that, with the CPI data coming out less than expected, we could very well see a breakdown from this level. And I'm just double checking that. Yeah, price is currently at 104.89. So it has now broken down below this 105.50 level and is currently at around this area here, matching previous swing lows. We could be in store here for a continuation lower and a few bearish legs for the US dollar, especially if the data that continues to come out in the next few weeks supports a dovish Fed. Gold finding a little bit of bullish price action yesterday, but it has definitely lost a lot of its momentum in the last few days. We saw a spike up in momentum due to geopolitical tensions, what's happening in Gaza, and we saw that price rally with a lot of momentum behind it all the way to 185. Started to lose out on that momentum. Also a major resistance zone, breaking back below the 21-day exponential moving average. So far above its 55-day exponential moving average. A weaker dollar could provide a bit of a tailwind higher, but we are seeing a bit more of a bearish structure here for gold, especially in a risk-on rally where we tend to see rotation out of safe havens like gold into equities and growth, especially the growth and technology names. So I do think there's more downside available, really. We might get a short-term reprieve higher, short-term retracement higher, but overall, it does look like 177 could very well be on the cards here. Okay, light crude oil futures. Bearish price action, no doubt about that. A lot of bearish momentum with price reaching negative 200 on the 50-period CCI, indicating an oversold condition. Breaking below that 79 minor level, coming back to retest it. So let's see how the price action behaves today. But we can see very strong bearish structure, a lot of bearish momentum behind this move. And that $70 level to the downside could be an initial downside target. We also have further support at 61 on the weekly time frame. So it does look like a bit of a reversal here for light crude oil futures, despite supply cuts that were initially pushing price higher. So sector rotation, we've had a bit of sector rotation in the last week. Big move here is still from energy, strongly rotating into that weakening category as oil prices continue to decline, and energy has a strong correlation with oil. We also have communications now finding a bit more relative strength. Like I said in the previous market outlooks, I definitely had a bit of a doubt with communications at the time. It provided a good risk to reward bearish entry point. However, now given a more risk on rally, we could see communications actually improve further. Technology, no surprise to see it back into the leading category, providing leadership as well. Remember, this has a high weighting for the S&P and has a high weighting for the NASDAQ, especially. This sector could very well drive the major indices higher. And a dovish outlook from the Fed has a very positive impact on technology stocks. Financials, yes, it's in the leading category. I wouldn't consider it to be a market or a sector leader because it's still quite close to the center here of this chart. So you normally want to focus a bit more on what's happening on the outside. So yeah, financials still losing out on the relative momentum though. Discretionary, industrials, materials, and real estate all in the lagging category and all continuing to lose out on that relative strength against the broader market. And we have our three defensive sectors in the improving category with utilities, staples, healthcare. I have a bit more of a bearish outlook on these sectors, or underperforming outlook on these sectors, I should say, given the fact that we are on a risk-on rally, and we should slowly see that rotation out of these defensive sectors into the likes of communications and technology as well. Okay, taking a look at the energy sector. So we know it's experiencing a lot of loss in momentum. You can see price has declined significantly during a time where the S&P and the NASDAQ have rallied. And now breaking below a bit of a support area at around that 85 level, coming back to retest it so far, this does provide a good risk to reward bearish entry point. So definitely one of the strongest underperforming sectors in the last couple of weeks. And when it comes to a downside target, I am looking at that $77 level. So we've been bearish on energy, since it was at 92 because it was at a major level of resistance. But Initially, I wasn't expecting a breakdown from support. Now that we have that, there is still further downside to be had, in my opinion. Okay, taking a look at our JETS position. So we were bullish at around that 1480 level, just below 15, where price formed a double bottom on the weekly time frame. Since then, price has rallied towards its 21-day exponential moving average. It hasn't moved that much higher, but it's not moving that much lower. So yes, maybe a bit of underperformance here relative to the broader market, but it's still provided a good risk-reward bullish entry point. That's doing quite well for us. So going to keep this on. This is a longer-term play as well on JETS. You know, one target could be at 1715, the next target at around 1950, and of course 22. Plenty of upside opportunity here for this ETF. Taking a look at some market observations, starting off with Halliburton, oil company, and we are seeing price at this major level of support at 38. So far, a bit of bullish price action. There's no doubt about that. But given the fact that oil prices are continuing to decline, I'm looking at a potential breakdown below 38. And if we can get that breakdown below 38, that gives a very strong downside move to 33. That would definitely be on the cards because there isn't really any other levels of support along the way. Maybe 36 as a minor swing level in the past. But again, oil prices are quite bearish. There's a lot of bearish momentum behind it. And Halliburton, we could very well see a breakdown of this support level. In addition to that, a lot of negative divergence, momentum making lower lows, whereas price is making momentum making lower highs when price is making higher highs, does indicate a breakdown is clearly on the cards, especially now with momentum being negative. JP Morgan. So JP Morgan, you know, I'm looking at financials as it has somewhat improved, but not by much. But JP Morgan's always and has been the best in class when it comes to the big banks for quite a long time. We've seen a strong recovery here in price, with price breaking above its 21 and 55-day exponential moving averages, as well as breaking above that 144, 145 level. So I'm looking for a minor retest of this area. So short-term pullback for a continuation higher, targeting that 150 area, next key level of resistance. And of course, you have plenty of upside all the way towards 160 and even 170. So JP Morgan, you know, on the weekly time frame as well, technically speaking, make it higher lows. We are seeing higher lows being formed. Yes, we've had a bit of a pullback on the weekly time frame for quite some time, but there is some upside opportunity from here as well, as it provides a better risk reward entry point for a move higher. General Electric. So this is a bearish idea with price, you know, at this major level of resistance at 117.50. I would like to see some bearish price action today first, at least towards the end of the day, to confirm that, because we know with the CPI data, the price is going to open up a little bit higher. So I want to see a stronger rejection of 117. And if we do get that, then that will provide us a very good bearish trade. We can see that's a major level of resistance on the weekly time frame, and we could fade it. We don't even have to target the 107 level. We can fade it as using a credit spread type strategy, where as long as price stays below 117, it will become profitable. So definitely want to add for the watch list for a bearish position if that's what you're looking at. I still think, you know, having some bearish trades in this environment is a good idea, because the rally does seem a little bit overextended, but the bearish trades would have to be very short duration. IBM, so our long-term bearish play, we saw with earnings a price rally to 143, and then with the Fed meeting, we saw it break above that level. So kind of invalidating our thesis, but prices only once again rally to the 150 major resistance zone. Fundamentals aren't particularly interesting for IBM, and therefore it hasn't really invalidated our broader thesis for this trade, as in that we are bearish at 150. 120 is still a long-term downside target. Might be a bit more difficult to attain in a risk-on environment, but still looking for credit spreads here to take advantage of a good risk reward to the downside, and once again breaking up this trade into a few different trades to gain that bearish exposure and to maximize the potential downside here for IBM. So FedEx, this is a bearish play from last week. We saw price reacting at the 250 level, moving lower, but since then it stayed above 240, currently at around 245. Pre-market today, let's see where it's at. Okay, back to 248, 249. So we're back to where we started. Not a bad thing either, not a good thing. I think this is simply, let's see and wait what happens. If price does break above 250 and close above 250 today, that's when you'd want to get out of this trade. General Motors. So General Motors, we were bearish last week when price was at 30. We saw bearish price action at a previous support level turning resistance, and so far worked out very well for us. Definitely time to be taking partial profits on this trade, and let the rest of the trade run if you really want to see how much further it can decline. But partial profits, that's yesterday was a good time for it, even day before, or on Friday, I mean. So with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you. Actually, I won't see you next week, as I will be at my wedding, but I will see you after 2 weeks. I'll be taking 2 weeks off. I will get a colleague to replace next week's Tuesday market outlook. And yeah, we will keep in contact with you regarding that. I know we will be canceling the following market outlook, most likely due to Thanksgiving and due to just lower volumes. So it'll either be next week or the week after that we cancel, but I believe next week is still on. So yeah, we will contact you regarding that. Anyways, yeah, thank you all. Thank you all for the nice messages. And yeah, I will see you in a few weeks then, guys. I hope you all do well during that time.